Hi everyone, welcome to Unit 3, Lesson 6, Economic Basics. Here are your objectives and standards which you can pause to read. You are engaged in economic activity every day. When you put on clothes, you are wearing goods that someone made and that you or your family purchased. When you eat a meal, you are eating the food that someone produced. That food was sold to a string of businesses until it was sold to someone in your family. How these activities fit together is the subject of economics. Economics is the study of how people meet their wants and needs. And societies must answer these three basic questions. What should be produced? How should those products be produced? And who will use those products? Here you can read about goods and services. Pause to read. Let's look at an example of how combining factors of production can make things more efficient. If we have 1 acre of land and we are harvesting wheat, if we use hand tools, it will take about 56 hours to harvest 15 bushels of wheat. However, if we upgrade our capital to something like a tractor instead of hand tools, we can harvest 40 bushels of wheat in less than 3 hours. Making choices. There is no limit to the things that people want, but there are limits to what can be produced. The difference between wants and reality creates scarcity, which is having a limited quantity of those resources to meet unlimited wants. Since people have limited money and time, they have to choose what they want most to use them on. The money or the time you spend on one thing cannot be spent on something else. And making these types of choices is called opportunity cost, the cost of what you have to give up. So for example, maybe I want pizza for dinner tonight and I have $15 to spend. And my town has 2 pizza places, Papa John's or Domino's. If I spend my $15, I cannot spend it at Domino's. And so my opportunity cost is the food that I would have got from Domino's if I spent it there instead. Now let's talk about supply and demand. Demand is the desire for a certain good or service. Supply is the ability and willingness to produce a good or service. So we're looking at what people want and what they're supplying. Demand and supply are connected to price, how much the consumer is willing to pay, and how much the producer is willing to sell that for. Let's take an example of apples. So let's look at this chart here. It says supply and demand for apples, and we have 2 lines, supply in orange and demand in purple. Let's say I go to the store tomorrow and I see that the price of apples is $2.50 per apple. I'm probably not going to want very many apples. So you can see here at $2.50 on the purple line, I might only want 5 apples. But maybe the next day I go to the grocery store and it says 50 cents for apples. Well, I'm going to buy way more apples because the price has gone down. I'm going to demand more. So you can see on our purple line, if you go to 50 cents, my demand there is 25. The opposite is true for producers. Producers don't want to sell many apples at 50 cents. They would prefer to sell more apples at $2.50. When the demand for apples is high, the price goes up, and producers are motivated to try to increase the quantity they produce. When the price is too high for consumers, the demand goes down, and the price goes down too. Let's look at profit. Businesses want to make profit. Profit is the money a company has left after subtracting its cost from the money it's received from its sales. To make a profit, companies try to reduce expenses and increase revenue, which is money earned by selling goods and services. Companies' profits are affected by competition, which is the struggle among producers for consumers' money. If one company raises the price of its products, another company may sell similar goods for a lower price to win more business. Companies also use advertising to help increase the demand for their products. An economy grows when businesses sell more goods and services. In a growing economy, prices may increase over time. This general increase is called inflation. Prices can also fall, and when prices decline, it's called deflation. Let's look at this chart from our book. Producers use resources to make goods and services. More producers means more innovation and lower prices. If there are fewer producers, there's less innovation and higher prices. Now let's look at consumers. Consumers use income to purchase goods and services. More consumers means more innovation and lower prices, and fewer consumers means less innovation and higher prices. Together, they create a market. Competition among producers and among consumers affects price, quality, and innovation. Now let's look at the three types of economies. The first is a market economy. Individual consumers and producers make the three economic decisions that we talked about at the beginning. A market economy values freedom, competition, and profit, and sometimes you can hear this type of economy called capitalism. The second is command economy. This is where the central government makes economic decisions. They value control, full employment, and social welfare over profits. Sometimes you'll hear this called a centrally planned economy. And then the third is a mixed economy. Both individuals and the government make economic decisions, and this values a balance of freedom and protection. And most economies fall under this term, including the United States economy. Let's look at how it works. So you can see we have households, which is what we belong to, the government, and firms or companies. So households pay taxes and they give money to different companies for their goods. Those companies or firms pay taxes as well, and they also have a monetary flow in wages that they pay to people who work for them. We also have people who work for the government who put things into the government through their labor. And people also give their labor to firms that you can see here in the orange arrows. Firms can purchase things from the government, and they can also do something called a physical flow, where they give those physical goods to households. And then the government gives back their expenditures to the firms and the households. So this is how money works in our society. It flows between these three groups: the households, the firms, and the government. And that is how a mixed economy works. Now, lastly, let's talk about personal finance. Income is the money that people receive from the work they do or the money they save or invest. It's the main resource people use to meet their needs and wants. Budgeting is a key tool in money management. A budget is a plan that shows income and expenses over a period of time. In a budget, income should be equal or greater to expenses. Budget should also include money reserved for savings. Saving is the act of setting aside money for future use. Many people save by putting their money in a bank. A bank is a business that keeps money, makes loans, and offers other financial services. Many people who save money in banks do so using checking or savings accounts. Banks may pay interest on money deposited in their accounts, and interest is the price paid for using someone else's money. The interest that banks pay is an incentive for people to save money. Make sure that you're continuing to fill out your reading guide as you work through the lesson, and reach out for help if you get stuck.